Thanks for that. Let's turn our attentions now to the Chinese market, world's second biggest economy when you basically strip out the Eurozone as one big conglomerate. But let's talk about what's happening in China. We did see inflation data year on year. The consumer price index in China increased 1% in February, month on month. In terms of the Chinese CPI, rose 0.7 of 1% year on year until February, which is above market expectations of a rise of 0.3. And it's a big turnaround from the sharpest drop in over 14 years with a 0.8 reading in January. Now, this is on the back of robust spending during the Lunar New Year holiday period. It's very clear, though, when you're looking at the chart there, Evan, that China is very much in a deflationary environment.
Yeah, and you've highlighted what also needs to be put into the big caveat that is the February data. The Chinese Lunar New Year is the seasonality outcast. And so if you took that out, it would have been another month of deflation. Now, there is possibly, and I know this is a bit cynical, a silver lining to this. China in deflation, they've always been accused of exporting deflation to the world. Well, right now we could do with that. We could actually do with Chinese deflation and actually having that come in. If imports are falling like a stone, like China is showing, that actually helps us because imports, the majority of what we get them from is from China. And if their prices are falling month on month, and realistically, as I said, you strip out Chinese Lunar New Year, would have been 5 months in a row, and we've had 6 of the last 9 months in that space, then that will start to help. It will actually help. Now, it's not good for China. I'm not sugarcoating that at all. And it's probably not good for the world. But there is that slight silver lining that maybe inflation gets down because import prices start to fall, just purely for the fact that China is having that. So even though demand is still relatively okay, supply is slowing. But if the price falls automatically because of another nation's manufacturing costs, then that's probably the only way to look at this with a good view rather than the negative view that it is.
All right, well, let's turn our attentions. Obviously, there's no inflation story there. So effectively the Chinese central bank has the opportunity to pull the lever, and that's exactly what they did. We saw the People's Bank of China, the PBOC, cut the reference rate for mortgages, which is the 5-year loan prime rate, by 25 basis points to 3.95% at its February fixing meeting. Now, this was more than market forecasts of a reduction of 15 basis points. Now, to put that into context, it's the first cut since June of 2023, but it's the largest rate cut introduced since 2019, as the board has definitely ramped up their efforts to spur credit demand and reverse the current property slowdown that we're seeing in that particular market. Also, they further supported lending and credit by the central bank, unleashing effectively 1 trillion Chinese yuan of liquidity into the banking system by trimming the risk rate requirements for commercial banks by 50 basis points and reducing interest rates on relending funds aimed at promoting loans for agriculture and also for small firms. So that just gives you some idea in terms of what's happening there. They've also got a challenging, slowing economy. We see that in the unemployment data. We'll take a quick look at that. We saw the unemployment rate in China has increased to 5.2% in January from 5.1% in December. To give you some context about the slowing Chinese economy, the unemployment rate in China averaged 4.74% from 2002 right up until 2024, reaching an all-time high. So the worst it's ever been under Chinese reported data is 6.2%, which was in February of 22, right in the middle of COVID. And the lowest was 3.9% in September of 2002. So, having an unemployment rate in the 5s when pretty much for almost 2 decades they're easily contributing, in unemployment at the 4 with a 4 in front of it, that's a real challenge for them. Looking at consumer confidence and sentiment, we saw that consumer confidence in China increased to 88.9 points in January from a reading of 87.6 points in December, remembering that a reading above 100 is optimistic territory, and it shows that the Chinese consumer confidence is still in pessimistic territory, but slightly improving. But it still, highlights the challenges facing the Chinese economy at the moment. Then we switch our attention now and we want to talk about, consumer confidence. We don't have anything in retail sales, so we'll move in to that business confidence story here. And we can see that the official NBS manufacturing PMI in China edged down to a reading of 49.1% in February from a reading of 49.2% in January, in line with market forecasts. This was the fifth straight month of contraction in factory activity amid an impact of week-long Lunar New Year breaks, and most factories were closed or slowed their operations. Here's the point that Evan was making before. New orders remained weak amid further declines in foreign sales. So that obviously means they'll drop the prices to sell more goods and export them, and that's beneficiary for us in terms of importing deflation as part of that particular story. The delivery time of good lengthens following a sequence of shortening to at least the past 12 months, and on price input cost inflation eased to an 8-month low, with output prices falling at a softer pace. Finally, sentiment did improve after hitting its lowest in 7 months in January of 54.2 versus 54 even. Evan, the Chinese economy is battling to regain the momentum that it had prior to the pandemic.
Yeah, and not only that, I think the other way to look at it, Ben, is that you can see the change in policy at Beijing has certainly changed the psyche about how things work.
Yeah.
And they're now at a point where they're actually concerned they've probably gone too hard. I mean, part of Xi Jinping's whole concept that he's done over the last 6 years is to get rid of shadow banking and its reliance, how much sort of capacity there's been in probably overspending and over leveraging is also the word. Local government particularly has had that problem. And then this is what happens when the back end is all of a sudden you start having this scenario where all those tightening measures that they've done over the last 6 years comes to a head. COVID's part of it, as you're right to high out. But then you look at what is going on overall you never saw the Thyssen numbers and the official PMI numbers below 50, which is obviously the difference between expansion and contraction for this kind of period. You never saw a scenario where what they refer to as their risk-return ratio, which you highlighted before, below sort of the lowest it got was about 18%. So this is, those ratios that banks have to hold a certain amount of cash on balance sheet. They always were proud of the fact that they had it basically sitting at 20%. And it's now getting towards what we have in the rest of the Western world, which is between 12 and 15%, which shows how much money they're trying to release back into the economy to try and move it. And it's just not. And that's the other thing. It's just not doing the same level. We're not getting also the roads to nowhere, the cities of nothing, all those kinds of cliche terms that happens with China. They're not there anymore because, again, the policy is actually to stop it. They don't want it to happen. But it does have a massive impact on psyche. It does have a massive impact on business confidence. And their property market is telling you that. So it's all part of that discussion.
Yeah, it's a fascinating story, and obviously they've got challenges ahead in terms of how they're going to try and get out of this. Also with an aging population challenge as well. Mm-hmm. All right, let's